So Tom Lee and Jeremy Siegel both just dropped massive interviews. The stock market is about to do something absolutely crazy. I'm going to show you both of these interviews. I'm going to show you my $800,000 portfolio. Every single trade that I have some huge winners, a couple losers. So here's the interviews. Stay to the end. I'm going to show you my portfolio. So here we go.
And CNBC contributor Tom Lee joins us on the phone, sticking with his target of 5,200. Tom, I know you agree the cycle has started and there is a Fed put in place, but it doesn't sound like you're willing at this moment to add a lot more risk.
I've got, I think, two time frames. I think what Steve said about the recalibration is really important because I think investors also need to recalibrate. There are too many that were in the camp of a hard landing coming or the Fed would be too late. And this Fed cut cycle, I think, is setting the stage for markets to be really strong over the next 1 month or next 3 months. What the stocks do between now and, let's say, the election day, I think is still a lot of uncertainty. And that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Right. With a preference for that over your traditional Mag 7 tech AI build-out trade?
I think tech and Mag 7 still keeps up with the market, and that's why if someone owns it and they have tax implications, I wouldn't sell it.
Real quick, so small caps is something that I have a really big trade on. I'm going to show you that in just a minute.
I guess then the risk to this, Tom, is that inflation comes back, right? If you're talking about this big cyclical recovery because of what the Fed's doing.
That's true. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance, I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply.
So I do agree with what Tom Lee just said about rising auto insurance. I know quite a few people in the insurance industry that are pretty high up, and they tell me that insurance premiums went up quite a bit in the last year or so, but they've reached a sufficient level right now to where they don't really have to raise it a crazy amount going forward. So as these monthly inflation reads come out, month over month over month, those insurance raises are going to be lower versus the previous year, so that's going to drag inflation down actually.
The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
So just think about it. If you're the CEO of any company and you're a very interest rate sensitive company such as Tesla, for example, or any automaker, you're going to be more cautious because if the Federal Reserve is signaling that they're going to keep interest rates higher for longer, meaning at 5.5% for 2 years going forward, you're not really going to be too aggressive making new factories or trying to expand your product lineup because you have to be able to sustain these high periods of high interest rates. So if you go invest into another factory, for example, Tesla, they were going to invest in another factory in Mexico, but they put it on hold because they don't know how long they have to try to sustain themselves when interest rates are 6%. But now that interest rates are coming down and the Fed is signaling that rates are going to fall down, those CEOs will get more confidence, which means they will be more confident to go spend money expanding their operations, which is good for the economy.
Jeremy Siegel is Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. He's also chief economist at WisdomTree. And Professor Siegel, this is what you thought the Fed should do, not necessarily what you thought they would do. What's your reaction this morning?
This was the best news I've heard from the Fed in years.
So Jeremy Siegel is actually a pretty smart guy. He's definitely kind of goofy, but he wrote a really good book called Stocks for the Long Run. I definitely recommend you check that out. But I'm going to play this interview right here, and I'm going to show you the $800,000 portfolio and the trades that I have in there to capitalize on all this stuff that they're talking about.
And the word recalibration is extremely significant. I think what they did is they said, listen, we're 100% towards our target on employment. We've got that back to normal. We're 80 to 100%, depending on what data you use on inflation. And we haven't moved at all until yesterday on the Fed funds. We say, the neutral Fed funds is 2.9%. And, why aren't we closer? We're now thinking about that gap, which is exactly what I talked about a month ago.
So the gap that Jeremy's talking about is the federal funds interest rate was 5.5% and the target range is roughly 3%. So we're 2.5 percentage points too tight. Now we did just cut by 50 basis points, but right now our effective tightness based on where we should be versus where the neutral rate is roughly 2%, and we already met our inflation target. So that means that we still have to cut roughly 2% to get to the level that we're supposed to be at right now.
And they expect one cut at every meeting over the next 6 meetings that we're going to have through June of next year. That will bring the Fed funds rate down 200 basis points to 3.33%, which is where I think it should be.
Jeremy, I can't help but think of what our first guest this morning, Roger Ferguson, had to say. He's the former vice chair at the Fed. He wanted 25 basis points, but he said you could make the case for either 25 or 50. His point, as somebody who's been in that room for a long time, is, maybe the market's getting ahead of itself. It got this 50 basis points, and now it thinks that that's the norm, and that these cuts are going to come fast and continuously, and that may not be the case. You said that the market welcomed a big cut and it wants more. What if the market is just getting ahead of itself and those big cuts aren't to come, that this was, okay, we're going to front end load it, and then we're going to go slowly? Would that be a huge disappointment?
So that's actually a really good question, because what if we're pricing in too many rate cuts or we're being too aggressive with the rate cuts? What happens if they don't come in the time period that we expect them to come in? Let's see what he says.
No, because as I mentioned, if I'm looking at the futures market, and by the way, I think right now the Fed dot plot is in almost complete sync with 25 basis points, not 50. I mean, clearly, if the data gets really bad over the next, few months, we will get some 50s. But right now, they will be happy 25 at the, November, 25 at December, and then in each of the first 4 meetings of next year, you do another 25 at each of those. That's all you need to get 200 basis points. That brings you down to 3.3%. Which is pretty much where I think, the Fed says 2.9 is their long run. I think it's a little higher. I think it's closer to, probably 3.5. So, they don't need 50. They say 20 at this point with
what
these
if
new
inflation
commitments.
Picks up? Because we're not at 2%. If inflation shows any signs of picking up and the Fed says, hold off, we're not going to do anything else anymore.
That's correct, but I don't see any sign of inflation picking up.
So now we're going to hop over to my trading account. The total value right now is $815,000. My 2-year return was $539,000. And there's been quite a bit of volatility along the way. Some of these big dips like right here, and this one right here, and this one right here, this is when I sold money on this account to go buy houses, so I use this money as down payments for houses. So these aren't losing trades right here. It's just me literally pulling money off of Charles Schwab. And just to show you this real quick before I show you the trades that I made, this is my rate of return for 2023. So I made 75% ROI in 2023. The S&P 500 did 26%, the NASDAQ did 43%, but I did 75%. And the important thing to know when you watch other people's YouTube videos is see what their net contributions were. So in this time period of 2023, I did not add money to Schwab to make my return go up 75%. I actually withdrew money from Charles Schwab. I did a net contribution of negative $24,000, meaning I pulled money off of Charles Schwab. So I started with $290,000 in the beginning of 2023, and I ended at $506,000 at the end of 2023 after pulling $24,000 off of Charles Schwab. So that's a net ROI of $240,000. So now going into my trading account specifically, it's $750,000 in that account because I have multiple different accounts. So this trading account alone is $750,000, but Charles Schwab as a whole is over $800,000. So you can see right here, my total unrealized gain loss is $262,000. Now the cost basis is not accurate because the thing how cost basis works is it just shows you how much money you paid for something, but it doesn't account for trades that you did in the past. So trades that I've done in the past that I made a bunch of money on, for example, I used to have a bunch of Apple stock and then I sold Apple stock. So I sold my Apple stock, it goes in my account in cash, and then I go buy shares of Triple Q, for example. But when I go buy shares of Triple Q, that shows up right here in cost basis. So cost basis is not really accurate because it's just showing of the current positions that I have open, what is my cost basis on those? But all the ones in the past, it doesn't account for those correctly. It just shows how much money did I put into Triple Q. So I'm going to show you the good and the bad of my portfolio. So I have some trades right here that I'm up a bunch of money on, but there's one down here that I'm down $15,000 on. I'm going to show you that one in just a minute, but we're going to go through my portfolio here. I'm going to talk about the margin requirements. I'm going to talk about what shares I have, what puts I have, what calls I have, and why. So Triple Q, I have 912 shares. The market value is $440,000, and I'm up $126,000 on that trade alone. VOO, I have 460 shares. I'm up about $63,000 on those. Tesla shares, I got 500 of those. I'm going to hold Tesla for a long time, and we're getting close to the Robotaxi day, so that could be a really big day for Tesla. So I think if Elon does what he says he's going to do with regards to Robotaxi and the Optimus robot, Tesla's share price is going to absolutely explode. I don't think it's going to happen overnight. I think it's going to need a few years for that trade, but that's why I just have my 500 shares of Tesla. The market value is $119,000, and I'm just going to sit on that for the long run. My cost per share on Tesla is $149 a share, and I'm up $44,000 on that trade right there. So now we're going to go into a couple of the put options that I sold. So whenever you see a minus right here, these are all options that I sold, so I'm short put contracts right there. And then these are options that I bought, so these are positive numbers. So I sold some Tesla puts at a 170 strike for $620 of 2025. I would be glad to take assignment of Tesla for $170 per share anytime between now and June 20th of next year. Now, I understand that you probably won't get early assignment, but if I do, I don't really care, and I have capital to take assignment of all of these contracts that I sell, just so you guys know. So this trade, for example, right here, if I sold 10 contracts at a 170 strike, this is 1,000 shares that I'm on the hook for to buy. 1,000 times 170, that means I have to be able to buy $170,000 worth of Tesla stock. I have no problem buying $170K worth of Tesla stock June 20th of next year because it's going to be farther into the future. Tesla's probably going to be worth more as a company, but if for some reason the share price falls, I have no problem taking assignment of $170,000 worth of Tesla stock. Now on the right-hand side over here, my margin requirement is $46,000. So what that's saying is I have to maintain $46,000 of equity in my account in order to support this trade. Now, a lot of you guys that use Robinhood, you're going to say, how do you only do it with $46,000? That's the difference of Robinhood versus Charles Schwab or just better brokers. Robinhood is typically where all the newbie investors go, and Robinhood wants to protect themselves because newbie investors get in trouble with options. You could definitely get in a lot of trouble selling these put options if you do it wrong, but if you do it correctly, you can make a lot of money in options. Also on options and the stock market, I'm building a course that's going to teach you everything that you need to know, how I built this $800,000 trading account, how I have a net worth of over $2 million in 5 years from nothing, and how I cash flow over $20,000 per month with stock options. I'm going to teach you everything that you need to know from stocks, stock options, taxes, psychology of money. My course comes out in the middle of October. There's a link in the video description for that. Get on a pre-launch pricing list because it's a really big discount, and after the course comes out, the price is going to go way up. So if you're interested in a course, definitely check out that link below. So you guys know I do a lot of puts on Triple Q. I have a contract here, here, and here, and my average strike price, I have 350, 350, 344, and 400. So my average strike price on the Triple Q puts, after you factor all that in, it's roughly like 365, and the price of Triple Q right now is 482. So I have no problem whatsoever taking assignment of Triple Q at $365 per share. Also, just so you guys know, I have all the capital needed in order to take assignment of these shares if need be. So if Triple Q falls a bunch in price and I get assigned a bunch of shares, one of two things could happen. I could either buy back these contracts right before the contracts expire and I just take the loss on paper, or I could take assignment of the shares, put my portfolio on margin while I'm sitting on those shares, and I'll just sell covered calls. And as long as the money that I'm making off of selling covered calls is more than the margin interest that I'm paying, I'm coming out ahead. But also keep in mind for one more thing. If my average strike price on Triple Q is roughly 365, even if it goes to 365, I still make money. Because remember, I made premium selling these shares. So I made $10 per share premium here, 12 here, 8 here. I made $15 per share premium here. Look at these Tesla ones. I made $30 per share of premium here. So over here, my cost basis, this is how much money I got credited. So I sold these Tesla ones for $30,000. I made $30,000 selling these 170 puts on Tesla. Apple right here, these puts that I sold, I made $20,000 in premium on that. I have no problem taking assignment of Apple for $220 a share, $12.19 of 2025. There's plenty of time left in this contract. That gives Apple plenty of time. That's going to be a whole new iPhone upgrade cycle, even after the one that just came out. So it's unlikely that the price of Apple is not going to be higher in the future versus right now. IWM, these are the small caps. I sold puts on that. I'm pretty much flat on IWM. I sold a 215 put for 620 of 2025. So in my previous video, I did a full breakdown on TLT and why I made the trade on that. So if you want to learn about TLT, I'll link that video at the end of this one. Actually, it'll break down everything that you need to know about TLT. But basically, if interest rates fall and bond yields fall, TLT will most likely go up in price. That's looking pretty good, and I think this trade could make a lot of money. I did March 21st of 2025 for the expiration date at a 101 call, and that one I'm down about $1,600 on. I'm not worried about that one. I know this one's going to take some time to play out, so we'll see what happens. And the second biggest loser in my account is these NVIDIA calls. I'm probably going to lose money on these calls, but I'm going to be patient and sit on them. And just take a look on the right-hand side. Percent of my account, it's 0.1% of my portfolio. It's literally nothing. These TLT calls, it's still less than 1% of my portfolio. So you have to understand, when I buy call options, it's usually a very small percent of my portfolio. And the biggest loser in my portfolio is SQQQ. So this is short triple Q. So I bought calls on short triple Q. So basically, if triple Q goes down, this will go up a lot in price. I bought these for $19,000. They're worth $3,700 right now. So I'm down $15,000 on that trade, but that's okay. I'm not going to get rid of this trade because this is my hedge against the market. And also TLT is also a hedge against the market too. The reason why TLT is a hedge is because if we go into a recession, the Fed will probably cut rates to 0. So TLT will go up, and there's a good chance that the market will fall in a recession. So SQQQ will go up in price too. So I have a little bit of a hedge between these two trades right here, but keep in mind it's a very small percent of my portfolio. And then after you factor in everything right here, I'm still up currently $262,000 in my portfolio. Not every trade's going to be a winner, but as long as the winners are bigger than the losers and I outperform the market, that is all I care about. So don't forget about the course that's coming out in October. There's a link below for that. I also have a free stock market blueprint that everybody should read. It's totally free. Link below for that. And if you made it this far, I make a video about every other day. Just like and subscribe, and I'll see you guys later.